Now, the Indian rupee has breached a key psychological threshold. The rupee has sunk past the 90 mark against the dollar, extending an 8-month slide. The slide reflects the growing pressure from the capital outflows, trade tensions, and also demand for dollar, and for dollar hedging. Now, over this part of 2025, the rupee has depreciated by nearly 5% against the dollar, making it one of Asia's worst performing currencies this year. The fall accelerated in less than a year. The rupee fell from 85 to 90, a much faster decline than its previous drop from 80 to 85. Key pressures behind the slide were rising US tariffs on Indian exports up to 50%, which has hurt the export demand and investor sentiment. The foreign investors have pulled out nearly $17 billion from Indian equities this year, intensifying the currency outflows. At the same time, foreign direct investment, the FDI, has weakened. Net FDI turned negative in September for the second consecutive month. On the trade front, India's merchandise trade deficit hit a record high in October, adding to the pressure on the rupee. The dollar inflows from sources like external borrowings and non-resident deposits have slowed down, while importers are rushing to hedge their dollar exposure, creating some added demands for dollar. Meanwhile, exporters are holding back the dollar sales in hopes of a better exchange rate, reducing the supplies of dollars in the system. The Central Bank, Reserve Bank of India (RBI), has intervened intermittently by selling dollars, but the pressure still remains. Its forward book shows short US dollar positions of about $63.4 billion, reflecting how much it's already committed to stabilize the rupee. Now, analysts say that the rupee has effectively become a shock absorber for the economy, bearing the brunt of external pressures while domestic economic fundamentals still remain really strong. If current trends continue, then weak inflows, heavy hedging demand, tariff headwinds, many foresee the rupee weakening further towards 91.30 rupees per dollar by the end of 2026. Now, this sharp decline in the rupee, despite India's robust economic growth, highlights how external pressures, tariffs, capital flight, and global investment sentiment are weighing in on the currency. Now, for the Indians, though, this could push up the cost of imported goods, fuel inflation, and also raise costs for overseas travel and education. For businesses, it amplifies the risks in foreign exchange exposure. As things stand, the rupee's path remains uncertain. But also, the coming months are going to be really critical for growth, inflation, and most importantly, for your wallet. For all the latest news, download the WION app and subscribe to our YouTube channel.